Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, everyone, how you going? Phil Tarrant here, host of the Smart Property Investment Show. Thanks for joining us. Before we get into it, I just want to address some feedback that I've been getting recently around the podcast, and I'll acknowledge it. That is, the feedback is a lot of people think that it's just been mainly professionals coming on recently from across the industry. So buyers, agents, accountants, mortgage brokers, and these type of peoples. And it's largely a deliberate tactic on our behalf. At this point now than ever before, Australian investors are scrambling for what they need to be doing, how they should be approaching and addressing this current market. So I've deliberately shaped a commentary around how we can speak to the industry about what they're seeing, what they're doing, what's working best with their investors to help deliver that information to you, our listeners, in a way that can help you make more informed decisions. So do not worry, do not panic. Rest assured that we will get back into a lot of the stories around investors. And the way I want to be doing that is that I want investors to be sharing their stories of how they moved and maneuvered through COVID-19. We've got a whole bunch of guests lining up, so they are coming. They will be there. But I think at this point in time, it's more about the information and giving analysis on what is a very fluid market environment when decisions need to be made quickly. And all good investors I know right now are looking at their numbers, they're looking at their financials, they're looking at their portfolios and working how they can eke the most effectiveness out of that as possible. And for many of them, it's coming around their interest rates and how they can capitalize on what is all-time lows when it comes to the interest rate environment. I know many people, and even sophisticated investors, who are now getting interest rates of high 2% and very low 3%, so with large portfolios. So if you are able and you're connected in with your rates and you have the ways and means in which you can help influence those, you should be concentrating on that. So that's very much today's chat. I didn't ask a investor to come and have this chat. Well, I guess he is an investor, but to have a chat with me in relation to this, I've asked someone with a good background, or very good significant background in mortgages, and someone who was my mortgage broker for many years before he hung up his mortgage broking hat. And now he is the guy who coaches mortgage brokers to do their roles better. Ross Le Quesne, how you going, mate? Coach extraordinaire, broker genius. What else are you these days, mate?
Oh, mate, I'm an avid traveller. I just spent 5 months travelling the globe and just got back before COVID, so I timed my run pretty well.
Yeah, you would have been locked up in a hotel for some period of time there if you come back any later, but it's good to have you back in Australia. And this is, I guess, Ross version 2.0. So you've stepped away from the full-time shoes of being a mortgage broker. And for those of you who are unfamiliar with Ross, he's been on our podcast over the years, mainly talking about our portfolio when he was our mortgage broker. You've hung up those boots and you've got another sort of set on now, and you're working with mortgage brokers to help them do what they do better for investors and owner occupiers.
Yeah, definitely. Working with some of the top mortgage brokers in the country at the moment. And really interesting listening to their stories. And some are really thriving where others are sort of, stuck in that sort of fear, or they've got so many clients that are sort of coming to them for assistance, and it's making what they do a little bit challenging. So just trying to make their lives a little bit easier and give them some good ideas on what they can do to sort of see this market through.
And I find, and you could probably speak more to this, is that most sophisticated property investors we know have a mortgage broker, right? It starts getting a bit hard if you don't.
Really?
Well, what are the best brokers doing these days in making them relevant, irrespective of who they're doing it for? Is it a good time to be a mortgage broker?
Oh, it's a great time to be a mortgage broker because, there's the lowest rates that we've ever seen. Cashback for refinances in the market, unlike we've ever seen, up to $4,000 some banks are offering in terms of as an incentive to refinance your loan. So, lots happening in that space. Obviously, from fixed rates, 2.09% for an owner-occupied mortgage. like that just seems laughable, considering I saw one of the guys from AFG posted something the other day saying, 5 years ago, rates were around about 7%, and we would have thought that was a good interest rate. I remember, when we used to do our property investment seminars, we would say an average interest rate that you'll pay that's been over time has been 7%. And today we're looking at rates 5% below what an industry average was over a long period of time of 7%. So there's massive opportunity in the mortgage space, and I think the reason that it's more important than ever to use a mortgage broker at this point in time is the fact that things are changing so quickly, right? So the banks are changing their policies almost on a daily basis on who they will lend money to. So a lot of it, given what's happening with the COVID-19 stuff, is around what industry you work in and will they lend to you for that industry, or will they provide you large amounts of cash out to do various different things. So there's so many different policy changes that if you're a broker that are on their game and keeping up to date with everything, you have a real opportunity in this market. And even around, there was an article that came out the other day in the Australian Financial Review that was saying that, clients aren't aware of what is available in terms of the loan deferment and options. I think it was only 30-something% of clients are aware. So the banks aren't doing a really great job at explaining what's on offer. So for the switched on mortgage brokers out there to even just to be that sort of market authority and give clients the information on what are the things that they can do in terms of putting their repayments on hold, or what options they actually have, makes it a great time to be a broker.
Yeah, and look, I'm leaning on my broker at the moment. It's pretty important, not only for preparing for the future and how at a point in time, if there is properties to capitalise off on COVID, but getting your portfolio right now. And, I'm nearly done the exercise, Ross, I'm halfway through it actually, to go through our portfolio to see where our rates are right now. And I haven't done it for, 6 months probably, maybe even a little bit longer. And some of the stuff I had that was sort of up over 5%, which I was grumbling about way back when, they're down in the 4s right now, but I still don't have any interest rates that start with a 3, right? And whether the argument is that I'm never going to get them because, of the size of my portfolio and how I sort of, borrow money. I'm not your typical vanilla home loan customer. There's still a lot of merit for me to go and do all those numbers and crunch those numbers. What would be your recommendation to property investors now to deep dive in their portfolio? And what do you need to know about your portfolio to help you make more informed decisions when it comes to finance in this environment?
Well, the biggest expense in any investment property portfolio is the interest by far. So, as you said, Phil, a lot of clients are sitting with interest rates right now that may have a 4 in front of them. So if you can get down onto, something down in the high 2s and, from an interest-only product, you can look at that. So if you've got 1% on a $1 million property portfolio, that's massive money that we're talking, right? This is in cash flow. That's big dollars, right? Big dollars. So and for clients that have a multi-million-dollar portfolio, we're talking, $3 or $4 million portfolio. That's $30,000-$40,000 back in your pocket based on 1%, for being 10 grand for every mil that you've got, if you can save 1%. So the savings are absolutely massive. So if, you can't do a rent increase or anything. So that's why it's so important to have a look at your interest rates, because it is your biggest expense.
Yeah, and I personally find it a hassle doing it. I find it a really tedious job going through. And each bank is different, trying to find exactly what your rate is, when your interest-only terms expire, all this sort of stuff. It is a nightmare, but it is in some ways, it's a therapeutic exercise because you actually see the savings you're getting. But to your point, our portfolio, we've got nearing, $5 million of debt in it. If I can shave 1% off our interest rates, that's a lot of money.
That's $50,000 in savings, right? And that's a net figure. So, that's an average Australian wage by just doing a review of your portfolio. Yeah. And so powerful, and something that, I recommend that people should be doing at least on an annual basis, if not more regularly.
Well, I guess in such a fluid interest rate environment and rates have been dropping, I think there was 3 interest rate cuts over the last year or so, the lowest that the cash rate has ever been. And many of the lenders have passed on those savings to the cash rate. They're all still got their margins packed into the fees. And you'll find that some lenders in this current environment are probably or have been more reluctant to reduce their interest rates. So you're going to start seeing a bigger gap. And Ross, you can talk to this, a bigger gap between what maybe the mainstream lenders are providing versus what maybe some of the second tier or non-bank lenders are providing. I think of one in particular who haven't been too accommodating on passing on those interest rate savings to guys like me, and I'm not going to mention them by name. But that's when you see those gaps arising, and they're essentially the home loans you need to be targeting for a refinance. Is that correct?
Oh, definitely, because you've got to understand that in markets like this, the capital markets shut down, right? So it's much harder for your second tier lenders to raise capital in markets like this. So the costs for them of funds becomes more expensive. So they're unable to compete with the majors that have these government guarantees and so forth, able to be able to compete in terms of rates. So yeah, definitely it highlights the opportunities. I mean, this is why you probably actually see, market share has moved away in the broker space. I think the figures were only 60% of the broker market was going to the majors. So I think where historically it's probably been about 80%. So I think you'll see that shift where the major banks will sort of start to get quite a bit of that market share back now.
Yeah, and that's a bit sort of technical. So what we're chatting about there is when there's more liquidity or the capital market's more accessible for your smaller lenders, they can deliver sharper interest rates. But when it starts tightening up, it means it puts upwards pressure on their margins, and therefore they're going to be reluctant to reduce the interest rates. So this is when you get this gap or this widening gap between fluctuations to the official cash rate by the Reserve Bank of Australia and not seeing that actually play out in your actual home loan. So there's always good cause, Ross, to have a diversified portfolio base when it comes to the lenders. But this is one of those points in times when too much diversification or too heavily weighted towards more specialized lenders can impact you. Because, with market share going back to the major banks, people are doing that because the interest rates are probably lower or is more accessible. And some lenders, and it changes all the time, are happy to put these incentives in place, around, I think you spoke about like $4,000 of like a cashback rebate or something like that at the time of purchase. Whereas you're seeing now some of the major lenders don't really want the business either. So there's a handful of them which is really emerging. Just not going to know that if you're not using a mortgage broker.
Exactly. There's so many different policies and stuff that is going on in the market in terms of, who will lend, what restrictions there are, and what sort of business they have as their appetite. For example, some of the second tier lenders, have said no matter even if they're employed, if they're just in those industries, it's a blanket no for them. So, how are you going to know as just somebody looking at lenders off the street on a sort of a rate chart or something? You can't know that. So your best interest is to use a broker at this point.
I think it's important, Ross. I want to have a chat about the different type of mortgages available because you might not be aware of them, but we'll go to a break beforehand. Back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Here with Ross Le Quesne. We're chatting all things mortgages. Now, Ross, before we went to the break, we're chatting about how interest rates can fluctuate depending on the lenders. Now, a lot of people are swept up in this headline of 2-point-something% interest rates, for owner-occupied. And you can even get that at investor level. But
yeah, definitely.
How do you balance chasing these headline marketable rates versus the reality of those products? And by that, I mean 2.09% sounds like a really nice interest rate, but I imagine it comes with a lot of restrictions, i.e. you probably can't have an offset connected with it. How do you get that balance right?
Well, there's a number of factors that you take into account. One is going to be, are they going to be able to lend you the money? Because, for property investors, there's certain ways that they will assess your income, and some are more favourable than others. So one, first, do you even qualify with that particular lender? What are the features or benefits that you're looking for your loan? As you said, Phil, do you need an offset account? Do you have a large surplus of funds? What is your plan for that property in the future? Do you want to add a granny flat on it? Do you want to subdivide? What is your future plans for development? Do you want to do some sort of renovations or construction on that property? Will all come down to which particular lender that you choose. And, a good mortgage broker will understand what your long-term plan or we used to say that your property is like a business, and they have to understand the business plan for your property to ensure that you're with the right lender that's going to tick all those boxes.
So what would be the key things you should be asking your mortgage broker about if you're looking to chase one of these sort of very marketable headline rates, whether or not you can have an offset or a redraw facility? Can you explain them very quickly? Because some of our listeners might not be aware of them.
Okay, so an offset account is an account, a separate bank account that you can have where you can put money in. And let's say, for example, if you've got $100,000 and your loan is $300,000, you'll pay interest on $200,000. So that $100,000 that's in that account will 100% offset the interest that you're paying. So there's two separate accounts. There's your loan account, shows a balance of 300. There's your bank account that shows the balance of 100,000, and you only pay an interest on the difference on the loan. So there's an offset credit put into the loan every month for whatever money that you've got in that particular savings account. So that's an offset account. The way a redraw facility works is let's say, for example, again, you had $100,000, you would pay that into the loan. So you've only got one account. Your balance shows as $200,000. But then you can redraw that remaining $100,000, which is another step process because you have to put that money into a bank account. So it's a two-step process to get the money out.
And this is, so the more sophisticated the features are of a home loan, typically the interest rate is higher. So if you want a really simple base, really, really low rate, it normally comes with no bells and whistles. That's right, because what it does, it shores up, it'll give certainty to the lender around the repayments around that or longevity of those repayments, right?
Yeah, not always, because sometimes they balance the low rate with some additional fees, like an annual package fee, So they might charge you $395 a year for the benefit of having an offset account and so forth. So sometimes you can negotiate a rate, but they'll make sure that it's under the package. So they tie up you with the annual package fee, and then there'll be other products attached with that, like credit cards and so forth. So they've got, their aim is to get you multiple products, so it makes it harder for you to leave.
So what's this comparison rate you always say? There's always an asterisk that says, your rate is 2.9%, but the comparison rate is 3%.
So the comparison rate takes into account all the fees and charges ongoing for that loan over a 30-year period. So it's a standardized thing that all lenders have to publish. But the reality is, Phil, that most loans don't go for 30 years. So when you look at those comparison rates, the average mortgage, I think, last time I checked was around, 4.33 years, because people look to refinance, increase their loan, restructure, switch to a fixed rate. So the actual term of the loan isn't normally 30 years.
So we sort of, that's a bit technical, the stuff we spoke about, but I think it's good for a refresher for a lot of people. When you're thinking of strategies and tactics in this current market, when cash is king and liquidity is king, something like a redraw facility or even an offset, which is even better, is a really good tool for driving down the interest that you pay, but keeping your cash ready to capitalize on opportunities when they're right to go. So, sometimes to give away a little bit more in interest to have flexibility to maneuver in a market if you are a buyer, that's a great thing. Now, we sort of talk a lot about this, and it's on smartpropertyinvestment.com.au, so you can go and check that out, a whole bunch of these different things. I want to chat a little bit more about the immediate market, COVID-19, and some of the challenges that investors are facing. We'll just go to a break beforehand. We'll be back in a moment.
Love property? The current Buyer's Agent of the Year and Director of Pure Property Investment, Paul Glossop, does too. And right now, he's offering you the chance to secure his best-selling book, A Surfer's Guide to Property Investing, absolutely free. Simply jump on Pure Property Investments Facebook page, hit the message button and type Smart Property to claim your free book today.
Welcome back, everyone. Phil Tarrant here, host of the Smart Property Investment Show with Ross Le Quesne, my old mortgage broker who's now not mortgage broking anymore. He's helping other people be better mortgage brokers. Now, Ross, COVID-19 has thrown the globe on its head, and Australia, to be fair, is probably proceeding or manoeuvring through it much better than some of our global counterparts, which is a testament to, not only government intervention, the way it's gone doing that, but I think all Australians embracing this whole idea of social distancing and the great work of our healthcare system. And thank you so much to all those people on the front line supporting the nation through this. But most property investors, rather than thinking, how can I actually capitalize the environment, are probably more in a, shit, what do I do about this current environment? I'm under stress, I'm under pressure. And with the guiding light, and this is by no means advice because I'm not qualified to give advice. This is just a couple of guys having a chat. But my view would be that at all costs, where possible, hold on to your house. Do not sell it unless you need to. It's when you're distressed to sell, when other people are going to get a bargain, and it's often very hard to replace it. So it all comes down to really smart cash flow management. If you've lost your job or you're in reduced hours or your family income has been reduced, you need to be right across that and understand what options are available to you. Hopefully, if that's the case, you're getting a job seeker or any of these other packages. But on the basis of holding on to your home, holding on to your investment property, Ross, one of the options available is this sort of mortgage holiday type of thing, or deferred payments on your mortgage, which everyone's hearing a lot about. Now, I think there's a bit of confusion around this because people think this is a brand new thing because of COVID-19, but this sort of hardship metric or this hardship solution that banks have had is not new by any means, is it?
It's not new, no, Phil. You're right in that you've always been able to access hardship. I guess what the new part of it is the fact that it's not going to have that long-term effect on your credit rating. It's not going to actually put you in arrears, which is a positive from the banks in terms of, they're being flexible in the fact that you can extend your term by an additional 6 months, and it's not actually going to throw you into arrears, which is going to make it easier when you come out the other side if you need to access funds or refinance. So it's always been around, but in its current version, it's a little bit more attractive.
Okay, so why would you look to capitalize on that particular feature as required? And maybe if you can actually articulate how it works, so you just don't pay your mortgage for 6 months, is that what happens?
There's a number of different options that you can take, right? So it might be if you're paying principal and interest repayments on your loan, you come back and pay an interest-only payment. So you're making the interest payments during the term. It may be that you just come to an arrangement based on what you can afford, or it might be the fact that you defer your repayments entirely for a period of 6 months. Which means, as you said, in fact, for the people that have sort of lost their job or don't have that ability to repay the loans, that they don't need to make a repayment for the next 6 months.
And it's actually guaranteed that there's not a red mark against your name saying you couldn't pay your loan during this period of time. Like banks, if you go and look for the new loan in 2 years' time, they've got to say, oh, well, Mr. Tarrant, you had to fall on hardship during that period of time. Like that is guaranteed.
Yeah, from the communications that we're seeing at the moment, that's basically what they're saying. It's not going to affect you moving forward long term.
So that's an immediate tool available to people to try and offset some of the hardship they may be facing in cash flow. So, if you can free up not paying those interest repayments for 6 months, I'm sure that will help a lot of people. And I guess the philosophy around that is the government working in lockstep with lenders, and whether or not that actually happens. But on the whole idea of trying to keep people getting thrown out of rental accommodation, right? This guarantee that's been put in place that people can't be evicted over a 6 month period. And I think that needs to be addressed as well. That people can't be evicted for the purpose of not paying the rent, but because of hardship. But you can still evict people during that period of time for other stuff, right? They're knocking down walls and smashing up the joint.
Definitely. And my suggestion to your property investors out there is to go through the process, and it's similar to the way that we would assess a loan application. Get as much information from your tenants as you possibly can. Really understand, are they getting the JobKeeper payments? What are their bank statements showing coming in and going out over the last 3 months before you just say, it's okay. Have that negotiation in place and have the conversations around, going through and understanding what their pain points are in terms of how much money's coming in, how much money's going out. I heard a client say the other day that, they wanted to reduce their rent, but they were spending, $30-$40 a day on Uber Eats, So, like if you can afford to get money and order takeaway in every day, but you can't afford the rent, there's something wrong. So you can come to sort of that negotiation around what's fair and reasonable.
Yeah, I've spoken a little bit about this, about my views towards it. I'm all for supporting people in genuine hardship, but people need to be accountable and responsible as well. And some people, and I've heard anecdotal evidence of this, are being opportunistic around this particular circumstances, thinking that, I'm just not going to pay my rent because I don't have to. But they've got Uber Eats and, online gambling is up 200 and something percent, right? Online shopping is up whatever percent. I think as property investors, and I'm obviously very pro property investment, why should we be at the last link in the chain? So, if people have credit card debt, if people have store card debt, if people have big screen, flat screen TV debt, if they have car loans and they can't make those repayments, it's the poor old property investors that's copping it on the chin because they can't evict people, right? So I think it's more than fair and reasonable to ask for an evidence-based from your tenants via your property manager, and I recommend doing it via your property manager to be disconnected with it, to actually show genuine hardship. And if you're seeing someone spending $40 on Uber Eats, like I used to live like that, Ross. I know a tin of baked beans costs $1 and you get a loaf of bread for $2, right? Like you can feed yourself on $5 a day. Don't worry, I've been there. So, it needs to be give and take. And there's a genuine negotiation. Thankfully, some of the states and the legislation around it or the requirements around it fluctuate state on state. It's a state-based thing, but it's got federal oversight. One of the states, Queensland, for example, went really down a path of proposing some pretty draconian, very pro-tenant-based legislation around this, which thankfully was balanced and sensibility prevailed. And it was very much around just be reasonable, negotiate. Look, don't throw people out in the street because they can't pay the rent, because they have genuine hardship, because they're completely unemployed. I get that. But, make sure people are being accountable and responsible on the other side as well. That's my view of it. It may be a bit more pointier than yours, Ross.
No, exactly. Well, we're both the same. We've got similar sized portfolios, so I'm sure you've heard a bit of that and I've heard a bit of that. So, it's just about working with your property manager and freeing it up. I laugh with you on the baked beans. I remember myself as a 21-year-old in Canada eating rice and soy sauce at times, right? You can get through.
Thankfully, hopefully I'm not thinking, but I can easily revert to baked beans again and Maggi noodles. It's a diet of kings and lots of beer normally. So anyway, so if you do have mortgage or mortgages and you do find yourself, in hardship in terms of meeting those repayments, and the key thing, Ross, here is that, it's recognised by all stakeholders that some people are doing a lot tougher in this current environment. So the worst thing you can do is put the head in the sand, bury your head in the sand and not do anything, right? If you are genuinely under hardship, you've got to speak to your lender, right?
And speak early, right? So speak before you even need to speak, because you've really got to understand what your options are. And even for the small businesses out there, there's so many different incentives. So if you haven't reached out to your accountant and spoken about what's available to you, you really need to do that, because there is so many things to help people get through the next 6 months that, which I think is probably going to help the property market as a whole, right? Because there shouldn't be too many people defaulting on their mortgages and so forth and for sales because of everything that has been put in place by, one, the government, and two, by the banks.
Yeah, and this is one of those things also where imperfect action is better than perfect inaction, right? So even if you might not get it right immediately, take action, do something and do it quickly and do it early, because there are so many things available to property investors to try and alleviate the need for having to sell your property. Because if you're looking to sell your property right now, it just means, number one, missed opportunity cost should you be able to hold it. And number two, you might not get its full value. So you could find yourself in worse financial situation as a result of selling. And that's an important point, Ross. That is, the decisions you make now are going to impact your portfolio into the future. This is not a knee-jerk thing. It's going to take 6 months. Whatever you choose to do now is going to impact the portfolio for a long time, right?
Yeah, for some people, there's going to be opportunities, as well. So obviously, if you sell when the market's down, that's going to have an effect. If you capitalise your repayments for 6 months, it's not that your interest stops, even though your payments stop. So that's an important decision to make, because based on, a $300,000 mortgage, your mortgage is going to be roughly $10,000 more than what it was if you do put that. So your equity in that property and your ability to borrow again, that might stop you from you getting to your next purchase, because you might need that 10 grand as your deposit on your next property. So you're not going to be able to make that repayment up as quickly. You're going to have to sort of double your payments over a 6 to 12 month period to sort of get that money back. So I think, any decisions you make shouldn't be taken lighthearted. You really need to think through and, seek advice from your broker.
Yeah, and that's a good point. Speak to the people who do this day in, day out, are a lot more connected to the market than you are. Other sort of cash flow management tips in this environment, Ross? Being across your portfolio, knowing your mortgage rates right now, potentially going on a holiday for your mortgages for a period of time, paying just the interest component rather than the principal component. Anything else available to property investors to keep the burden of cash at bay?
Obviously, with the savings that you're going to make from renegotiating your interest, putting that into an offset account, or you've already been paying that money already. So let's say, for example, you save $1,000 a month. Put that $1,000 a month into an offset account, or just keep your repayments what you were paying the same, but have that money sitting in an offset account. So you're creating these buffers. So if you do have tenants that are missing their repayments, that you've got a cash flow buffer in place for yourself. So just really ensure that you've got those cash flow buffers is more important, now more than ever. And also, keep an eye on the market in terms of, there may be some good buying opportunities as we sort of move through this as well.
And your recommendations for someone that's probably done this 1,000 times, for someone who thinks their interest rate isn't as sharp as what it should be, what's the best way to go about getting that reduced? Do you just call up the bank and say, hey, look, people are trying to refinance my loans. I get $4,000 over here. What can you do better on my interest rate?
Yeah, so if you're direct with a lender, you can definitely do that. Obviously, if you're using a broker at the moment, go to your broker and they can apply for pricing directly with your existing lending. So that may bring you back to sort of where the market is. And if it doesn't bring you back to where the market is, then at that point in time, you can have a look at your options refinancing. Just note, if you are on fixed rates, there will be break costs involved in changing your mortgage. So you don't want to do that.
That's a good point. So I was going to ask you just quickly, we've got to wrap up, Ross, but fixed versus variable in this current marketplace. They always say variable rates win, but would you be fixing right now?
And there's some really sharp fixed rates at the moment. And, with cash rates, it's sort of 2% for an investor that's got a number of properties. And, even you look at sort of a low rental yield, which is the income that you're getting in your property, you're probably looking at a low yield is sort of around 3%. So to fix under what the yield of your property for a property investor, to me, it's not a bad idea. But again, with a caveat, it comes into what are your long-term plans with that property? Are you looking at doing anything that may force you to sort of refinance that property within that period of time? You need to consider.
Good point. Interest only versus principal and interest?
I've always been an interest-only fan for investment. I think, any principal should be directed to any owner-occupied debt that you've got, or potentially if you're still in that accumulation phase of your portfolio, putting into an offset account to sort of build a war chest for your next deposit if you can.
And again, that's just a recommendation. We're not providing advice at all. Everyone's circumstance is different, so make sure you go and speak to the person you need to get that right. I hear there's a whole bunch of incentives that are getting bandied around getting rid of stamp duty, right? And I think the Victorian Premier was out today in the paper sort of saying, hey, Victoria's always led the way on changing regulation and removing inhibitors to commerce and red tape. They're sort of flagging they want to take the lead on removing stamp duty, which is a really easy way to try and stimulate market activity, isn't it?
Yeah, it is interesting, but at the same time, it's one of their highest revenue generators as well for the state government. So I know Victoria has actually one of the highest stamp duties of any states, and they haven't adjusted their tables since for years. So whilst it was on a percentage base, the amount that as property investors that we need to pay is one of our biggest, what is the biggest on cost in getting into a property. So yeah, definitely remove that cost. It does make it a little bit more attractive, doesn't it?
Oh, it makes it very attractive. Well, you think about how, and for those who aren't familiar with this, property and employment is very much a state-based tax. So, nearly all state governments make their money through three principal ways. One is land tax, the other one is payroll tax, and the other one is stamp duty, right? So as property investors and running SMEs, you get hit three times, right? So any way in which you get a bit of a break on particularly stamp duty, just for the transaction of the sale of a property, that'll be really, really good way to get markets moving again. And, I know New South Wales been tinkering with discounts on land tax, but I think there's some small number of people actually pay land tax as property investors in New South Wales. Most people hold property in New South Wales in their own names, and if they don't have a huge portfolio, they're not paying land tax on that.
Yeah, exactly. I mean, most people wouldn't hit that threshold, but obviously, for the serious investors, because most mum and dad investors only own one or two properties, it's once you get over the sort of that number, I think the percentages of investors, drop significantly. But, I can't see it happening, but who knows? Yeah.
Yeah. I'll close with this question, Ross. Some of the lenders have come out and there's been a noise around it that they're not following through with pre-approvals that they have put in place prior to COVID-19. And so a lot of people are thinking that they can go out there and buy a property based on a pre-approval they might have received in February or March. But when it comes to actually getting the loan, those things are falling through purely because of the changes in whether it's industry circumstances or they're doing a whole bunch of serviceability checks around your ability to generate the income that you had at that point in time. What's the best way to navigate out of that? Should you go back if your circumstances have changed to the bank and say, hey, look, does this pre-approval still sit as it is right now?
Definitely. And especially if you're in an industry where it is known to be affected by COVID, because it's like anything. If you were lending your money, Phil, you'd want to know that you're getting it back and you want to know that there's not a high risk of not getting it back. So if you're in one of those high-risk industries, for sure, you need to double check that. But obviously, it makes sense in this market because banks are doing strange things, even if you're not, just to double check that it's all good.
And this comes back to opportunities for investors. If you're an SME or you're working more high risk industries, maybe you're going to be challenged to secure financing right now. But for those people who are in safe as houses jobs, so if you're in the medical industry, if you're a nurse or if you're a police person or you work within government and you have a lot of certainty around your employment, the reality is there is opportunities in markets right now with less people in the market. Maybe you can bag yourself a bit of a bargain. So maybe people can reshape or rethink or their timing around getting in the property if they are in those safe positions.
Yeah, definitely. And that's what we're seeing in the market at the moment from what the brokers are telling me. There's the opportunists, people that are looking for opportunities are in the financial position to invest. And then you've got some people that are, stuck in fear. And then you've got some people that are sort of just hiding away with all their rolls of toilet paper waiting for this thing to be over. So, because there is a limited market in terms of because you don't have as much competition for properties, those opportunists, as you said, may be able to pick something up at a little bit lower price.
Yeah, and it sort of lends itself also to the whole supply and demand discussion, which is outside of the remit of this chat. But listings are way down. Stock and market is much lower than what it was prior to COVID-19. So there is still some pressure on properties, and we've been having chats, Ross, around sort of wholesale potential reductions in values, and some of the smart people in banks and some of the economic institutions, those numbers are hovering anywhere from 5% to 30%, or some doomsday merchants talking 40%. So you need to be pretty sure, a lot of those numbers are general and it talks about all markets, whereas different markets are going to operate differently. So the opportunity for property investors is really understanding what they want to do, what they want to achieve, and what's the right assets for their portfolio at this point in time.
Oh, exactly. I mean, and because there's uncertainty in the market, we don't know if we're going to have round 2, round 3, round 4 of this. So I think it's just that uncertainty that plays out. And a lot of the media like to work on worst case scenario is 30%. But, I saw some other arguments that are saying, well, the share markets, drop significantly. And what happens once the share market drops is there's a flight to more stable and secure assets, which, property is seen as potentially that. So who knows, Phil? And that's the thing. There's an uncertain, but I guess it comes down to our point before. If you're in one of those stable positions and you've got a stable financial position, you've got the buffers in place, you can handle a period of uncertainty in regards to rental income, and you've got the cash flow to do that, then there's definitely going to be some opportunities out there.
Get into it. Ross, thanks for your time today, mate. It's always good to have a chat, albeit sort of over Zoom. I'd much rather be in the studio. And I'm conscious also, we're big stickers on quality here. We haven't got the same studio quality that we normally would have because we are doing this over the web, but we're just being responsive to this market and making sure we keep connected and keep this information coming to property investors. So thanks for joining us today, mate.
Pleasure, mate. Pleasure to be chatting even over Zoom.
Nice one, mate. We'll get you in again soon when we're allowed to talk all things mortgages. And at a point in time, Ross, maybe we can have a chat about your portfolio. You've been a bit cagey on that over the years, so maybe you can tell us what's going on in it.
All right. Sounds good.
Sounds good. Thanks for joining us today, everyone, on the Smart Property Investment Show. As I mentioned beforehand at the top of the podcast, we're going to start getting a lot more investor stories back onto the show. But at this point in time, we just really want to share this information with you from people that are operating within this space. You might not have access to them yourself. So hopefully through Smart Property Investment, you're getting the voice of some very smart people who operate in this area who are giving recommendations and advice to property investors day in, day out. So we'll keep at that. But if you want to come and have a chat with us, if you want to tell us about your COVID story, we want to start having those stories. You can contact the team here, editor at smartpropertyinvestment.com.au. Please do that. And even if you've just thought about investing in property or you've got a huge portfolio, you want to chat about what you've done through COVID-19 and maybe what other property investors can learn from that, let's get you on. Let's have a chat, editor at smartpropertyinvestment.com.au. Remember, social media, if that's how you like to get your information, Smart Property HQ. That's it from me today. I hope you've been enjoying the show. We enjoyed delivering this to you, and we'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyer's agency.